Welcome to Talk Tickers. Today, we're diving into a real head-scratcher from Casey's General Stores. They just dropped a killer earnings report, a classic beat and raise. But then, the stock sold off. So what gives? Let's get into it.
So here's the game plan. We'll start with a quick snapshot of the quarter, then dig into the margin machine that drove these numbers. After that, we'll tackle that weird sell-off, look at the guidance and any headwinds, and finally, I'll give you our take with the next call. All right, first up, the quarter itself. And honestly, it was a classic beat on all fronts. On the surface, Casey's absolutely crushed it. Let's kick things off with earnings per share, a whopping $5.53. That's up 14% year over year, and it sailed past what the analysts were predicting by a solid 6%. A really strong start. And the top line looked great too. Total revenue hit $4.5 billion. We're talking a 14.2% jump from last year. That growth really came from having more stores in the mix and just great inside sales. Now this is the number that really tells the story of profitability. EBITDA. It's a metric management loves to talk about, and you can see why. It shot up 17.5% to over $410 million. That is just a massive expansion of their core profitability. Okay, so how did they actually pull off these fantastic numbers? Well, it's not just about selling more pizzas and gas. The real secret sauce this quarter, it's all about margins. And check this out. Inside store gross profit, a very healthy 13.5% growth. Great. But look at the fuel side. A massive 21% jump in gross profit. That is where the real magic happened this quarter. They were just printing money at the pump. And the CEO, Darren Rebelez, basically confirmed this. He talked about how strong sales and traffic were, especially for things like their famous pizzas, sandwiches, and drinks. The high margin stuff. That's what really drove people in the door and juiced up those inside margins. So let's just recap for a second. We've got a beat on earnings, a beat on revenue, and they raised their guidance. Everything you'd want to see, right? You'd think the stock would pop, but nope. The market's reaction was paradoxical, to say the least. Despite all that fantastic news, the stock took a nosedive, dropping over 5% after the announcement. And this wasn't just a little dip, The trading volume was more than double the daily average. That tells you big money was moving, and investors were clearly spooked by something. Which brings us to the million-dollar question. What on earth spooked the market? Well, it turns out the sell-off wasn't really about the quarter they just delivered. It was all about the future. First off, you got to remember the stock had already run up 33%. It was at all-time highs, so some profit-taking was probably inevitable. But beyond that, investors started asking some tough questions. Like, can these record-high fuel margins actually last? And what's with operating expenses jumping almost 17%? And then there's the big CEFCO acquisition, which brings in lower-margin stores. That could dilute the overall picture going forward. Okay, so let's shift gears and look at the road ahead. What is management actually telling us about the future? And does their guidance address any of these concerns? And this is the raise in beat and raise. Look at that EBITDA growth guidance. They bumped it up big time, from a 10 to 12% range all the way up to 15 to 17%. That is a huge vote of confidence from management. They also held their other key metrics steady, which tells you they feel pretty good about their plan for the rest of the year. But there's a catch for the second half of the year, and it's a little bit of financial jargon called lapping an acquisition. Basically, the huge CEFCO acquisition they made is now going to be in last year's numbers and this year's numbers. So the year-over-year growth is going to look slower, just mechanically. It doesn't mean the business is doing worse, it just makes the comparisons tougher. It's a key thing to keep in mind. All right, let's tie this all together. We've got a fantastic quarter, a jittery market, and a kind of complex outlook. So it's time for the next call, our take on where Casey's goes from here. We are initiating our coverage with a market perform rating. Now, what does that mean? It means we think Casey's is a solid company, a great operator, but it's also facing some real headwinds. And the stock is pretty fairly valued right now, especially after that dip. So here's the core thesis. Casey's is absolutely a best-in-class operator, no doubt about it. But the stock is facing a fair valuation, and there are legitimate questions about whether these awesome margins can last. That's why we think the post-earnings drop wasn't a panic sell. It was actually pretty rational. So what about a trade idea here? Well, with the stock pulling back, volatility is up, and that makes options more interesting. One idea is to look at selling cash-secured puts. The logic is pretty simple. You pick a price below where the stock is trading now, a level you'd be happy to own it at. Then you sell a put option at that price. Two things can happen. The stock stays above your price, and you just get to pocket the cash premium you collected. Or the stock drops, and you get to buy a fantastic company at a discount. Kind of like getting paid to wait for your perfect entry point.
And of course, please remember, this is not financial advice.